90% of property investors in this country have only one or two investment property. You fail to plan, you're planning to fail. Which says that if you need to know the path ahead, just ask someone who's coming back.
Hello, I'm Alex, Upworth's co-founder and CEO. Welcome to a new episode of the Upworth Talks, the leading personal finance interview series with extraordinary characters brought to you for their achievements and stories. My guest today is truly special. A migrant, he arrived with no money in Australia. Soon enough, he realized he had to find a way to invest in property to build a better life for himself and for his family. In epic fashion, he took out $80,000 in credit card debt. He went on buying 15 houses in the next 6 years. Today, his portfolio is worth $7 million, half of which, $3.5 million, is equity. 44 times his initial $80,000 contribution, taken with credit card debt, interest-free. How to get started in property investing, how to build smartly a multi-million-dollar property portfolio, which seems like a distant dream. Where does it make sense to invest today? Who better than my guest to tackle those questions today? Rasti, welcome on the show.
Thank you so much. Thanks for the introduction. Really appreciate it.
Thanks for accepting the invitation. I must say, we met in an interesting fashion. You reached out to me on LinkedIn. I replied to you. We didn't know each other. And it has been a few months now, I think, that we got to know each other. I've always been astonished by your story. And I think the really interesting part of your story is also your personal journey, like where you started professionally, what brought you to Australia, the multiple career changes. Maybe do you want to start there, by introducing yourself a little bit more?
Sure. No, before I get into it, I really appreciate you connecting on the LinkedIn. And the reason why I actually got connected was the work that you do at Upworth. It's amazing. It's amazing. It's really, we believe as a business as well as me individually, it's all about holistic picture of anything. When we clearly understand where you want to go and what our current position is, things are much more easier. But the challenge with the financial markets is that it's so much disintegrated. My one bank doesn't talk to other bank, and we have no clarity what's really going on, what my money in my left pocket is, and what my debt level is on my right pocket. So what you guys are doing at Upworth, it's amazing. So that was the reason why I actually reached out, just because I'm pretty impressed, because this is something that I really wanted to have for myself at my earliest days. I'm still very much valuable today because more stakes are there. But thank you for connecting.
Thanks for sharing. You put a lot of work into this, so thank you. Thanks for the kind word.
Yeah, so coming back to my story, as you said, yes, it's very daunting thinking about debt on credit card, but I'm a numbers person. So I thought that, people in general, and I'm saying people, me included in those days, is that it's a struggle to get a deposit accrued over a period of time for our property.
Yeah, it's usually one of the biggest pain points, right?
Biggest pain point, especially the affordability that we see, or lack of affordability. Of course, this deposit is one part. Then the second part is the stamp duty and the other expenses around it, plus the buffer you need to have, and the whole thing around whether it's a negative cash or positive cash flow properties. And when you're talking to buy your own property, then it's like, oh, geez, it's a huge commitment getting into that thing that which people believe that they're buying forever. Data shows it otherwise. In Australia, an average Australian family holds a property for only 7 years.
Okay, well, okay.
Whoever is buying it, they think that this is it. This is their property for the lifetime. But then the 7 years holding period at most as an average.
Yeah.
So what it tells me is that things change. People change. The preferences change. The circumstances change. So anyway, coming back to my story, it was like, okay, do I really want to buy a home, or do I want to go for investment property? That was my, dilemma, like lots of people have, that yes, I want to buy a home, but I can't afford to buy a home because the kind of home I like is probably out of my reach.
Like many people.
Like
all of us.
Me included then, or me included now. So it's out of reach because our reach, probably our aspirations. changes over the period of time. So that was one question. Then the second question is like, whatever I have, not so much in terms of my funds in my pocket, because I went to choose to go for my MBA in finance because I was, so my background is probably a bit diverse.
I think it's an interesting part. I think you should tell us a little bit more because you started by studying architecture. You went to being an IT guru. Then you went to manage, like billions in the fund. You did an MBA. You're a man of many trades. I think maybe it's worth, emphasizing that a little bit.
Thank you. And I think it's very critical or important for the audience to even know this because it sounds very fancy, taking 80 grand debt.
And sounds like a daunting. It's like, okay, but this guy is a genius. It's not me, so what he does is not for me. But I think that's, well, I'll let you share. But
sure. So my background is that I always want to be an architect. My property has always been my passion, even in my childhood, for the simple reason is that to me, it's science and arts together. The culmination of science and arts is probably the whole mankind. I guess it's either form or science. So to me, it was more of a tangible product that comes out of it for someone to live in, as well as it's a expression. So that was the reason property has always been my passion. I want to be an architect. I became one. But the reality is, the backstory is that I lost my father when I just finished my high school. So, and I was the only son of my parents. And being the youngest, but yet the whole responsibility in my Indian, like I'm Indian. So the way it works in our Indian families is that the male becomes the head of the family, figuratively. And it came as a responsibility because for me, it's like, it's just a story very quickly that I was actually on a sleepover at my friend's place. There was a knock at the door. And my dad's friend came over to fetch me. I was like, see, Ian, what's going on? And he took me back home saying that, look, there's something important. I was like, still rubbing my eyes, not sure what is going on. Came to my home. It was an average home, coming from a very average middle-class family. My parents have struggled to put food on the table at one stage, but we grew on the back of education and doing things. My mom really took some a very simple job. Like she started a tailoring shop at home itself just to survive. That's how we have gone through the hardship. And now all of a sudden I see that the neighborhood is actually all lighted up. 3:30 a.m. in the morning, like what's going on in the neighborhood? All street lights gone up and there's a huge crowd of people standing in front of my house. Literally shocked and walked in very swiftly and saw my mom hysterical with my dad on the floor.
Sorry.
And I was still shocked, but and then I didn't know how to respond. I'm just 17 years old, and I walked in a room. All the family, neighbors were like, "Oh, no, bring him home, bring him back. Maybe he's in shock." All I could say to my mom was that, "Don't worry, I'm here."
Impressive reaction. I mean, it's like, yeah, okay.
So I get goosebumps, and that. So those few words probably didn't mean much to me then, but has huge weight. And to me, it was like, okay, now I'm the head. I really need to take care of our family. So all of a sudden, lucky girl, married person, all of a sudden it's like, okay, what do I do now? I wanted to be an architect. I went to college, realized that in architecture in India, there's not much money in the beginning years. So I really need to find an alternate. So I started learning programming, IT programming on my own. Without a computer, just without a computer. Put in a force.
How do you do this?
So it was all through the books, like bookish knowledge. Wow. Like I read, throw me a book, I was reading it because I thought that this is the only my ticket way out to come to the center, to support my family. And yes, I need to be as an architect. I was a meritorious student, don't get me wrong. But for me, it was like, okay, can I afford to wait 5 or 8 years after that 5 years degree program?
Like property investing, like can you afford?
Yeah.
You already that mindset.
Yeah. So for me, I couldn't really see that. And I did I learned programming and started doing, some little bits in different offices that, okay, I can do this tele job for you. Or that's how I started learning about programming. And fast forward a couple of years later on, like I knew about programming, and I got a job in IT programming as a programmer.
And you're still in India at that time?
Still studying architecture.
Oh.
So I didn't finish my architecture. I mean, I was still doing this in parallel,
Yeah.
but before I finished my 5 years degree program in architecture,
Yeah.
I actually had a job in IT. So that's how I made a switch, and I was like, okay, I was so dedicated to do this. And to me, it's like I started doing work, I changed cities. And then I realized that, like if this is what I can achieve, it's just pretty good success from that point of time. But then, when you can go and achieve anything, that confidence means a lot. And for me, it was like, okay, if I could get this just by my own bookish knowledge and determination, why don't I put the vision on doing something big? And for me, I've always believed that there's always mentors out there. There's always successful people out there. Rather than you try to figure out on your own, why don't you learn from them? Why don't you just find them and go for those coaching or the mentorship? And that's how I actually grew in my IT career. Came to the point that, yeah, this is awesome. This is awesome. Like I'm going up the ranks. But what if I go for a formal education? Because I was still an architect with that degree.
Yeah.
And that's still learner. So for me, it was like, okay, where do I go for my master's in computer science? So that's what I pursued in Singapore. So I moved to Singapore. Of course, I couldn't afford it by that time. So I went there as on a working visa, and then I studied master's computer science part time from NUS, National University of Singapore, one of the best rated university. I did that in parallel, so I was doing things, what
Well done.
So there's a statement, from Alibaba co-founder, that what you do in your normal day or normal routine is one thing, but what you do outside of your working hours in your spare time defines who you will become eventually. So for me, that really stuck to me, and I was like, okay, I want to do more. That's why part-time studies or improving myself and studying. So that's how I really, probably take too long to.
No. Sorry, fascinating.
So from architecture to IT, that's how I became from India to Singapore. That was happening. Of course, fast forward a few years, I got married, and I was like, okay, what's the best country? Because Singapore was more of a selection based on the education. Yeah. But now I have to choose where I want to go. Yeah. Because I'm a firm believer, just like for anything in architecture, we have to design that as a concept on paper. Then you go about executing it. For that reason, I was designing my life. Yeah. For me, it was like, okay, I go, because Singapore is great. I love that country. I still love this country. But the work-life ethics or the balance is probably missing to the extent that what we see in Australia. Yeah. So I really have to fast forward a few years and see myself running as a family person. I thought Australia is a far better country, so I should really pack my bag and come here.
Pretty cool. I very much agree with that. Choosing your country has lots of impact on your life, basically.
So. Totally. And I have a huge gratitude for what we have received and the privilege to choose the country and being able to make it, and it's such a welcoming country. So 2006, we came over here with nothing almost, because Singapore was not really a country that you save money and, I have to still support my family back home. Yeah. So nothing much in my pocket. We came here. My wife followed. Of course, I came first to find a job. Okay. Once I've got a job, then I said, okay, let's pack the bag in Singapore, come over.
And so here in Australia, you started in IT?
Yes, IT, yes.
Okay. Well, working in which industry?
So I was leading the business intelligence side of things, like Microsoft. So I worked with a company called Avanade.
Okay.
So Avanade is a joint venture of Microsoft and Accenture. So love the exposure, love the ethics, love the culture. But for me, it was again, designing the life kind of thing, and money was not enough. So I tried to do a few things, like currency trading and, stock investing and mutual fund, because working so hard for the money and do not know what to do.
And you wished you had Upworth back then.
Was that sorry?
You wished you had Upworth back then to help you manage your positions.
Yeah. Only if you had money, right? So I didn't have much money. So it was playing with penny stocks. And nonetheless, this is good. This is where my real interest is, because multiplying money is an awesome thing if I really learn the tricks and trades. So, and that really, a thought stuck to me, and I was like, why don't I study finance?
Search it.
So first, like, call it midlife crisis or whatever.
Yeah, how old are you actually, if I may ask? It seems you have had like 3 or 4 lives already, and we're not at the end of it, for sure.
Yeah, also my daughter, she will say I'm still 18 because I call I'm 18, right? So
I love it.
then I have to say it's my biological age is 47. So biological, like 76 born. So yeah, so 2006 we came here, realized that we probably should be pursuing finance as something to learn. So quit my full-time job. I wanted to go to full-time MBA. That's what I did.
In Australia?
In Australia. I wanted to go to US to start with. Yeah. But we were, like my wife was pregnant with the first child. So I thought, okay, can't go anymore to US. So the next best option, or the best option in Australia is AGSM in UNSW. So I did full-time studies over there, but I really wanted to go to Booth Business School in Chicago. So I picked that as my exchange program. So I still made it to Chicago. Lovely school. But now we're really talking about 2008, 2009. Someone trying to change careers from IT to finance.
2008.
CFC. So global financial crisis, the banks were shutting their doors. They were not really accepting anyone. People migrating back from the US or the Europe, and there was a crisis. And for me, again, that was a moment of truth that, okay, what do I do? I could easily go back to IT because now I got an MBA, which is and very good career in IT, and I was already doing it. But it was more of my resilience that, okay, I really wanted to go that far. This is my journey. This is my path. Yeah. If I look back, then I'm actually losing the opportunity, or yes, there's the opportunity cost, but I'm undoing what I've just done so far for the last 3 years. So it was my commitment and resilience, as well as support from Rupali, my wife, that, it was not easy. With first child, no job, trying to do something with not really many open doors out there.
Crossing points.
So it was my commitment to make it happen that I really kept it doing. And the challenge that I was receiving, or the feedback, was that just by doing a generic MBA is not good enough. Yes, I made it to Chicago, but so what? What have you experienced? What you have done? And that really got me thinking, and I had to pursue CFA. So I'm a chartered financial analyst. People take ages to do it. So I did it. I had no choice, but I had to do it. So did that in 3 years, which is the shortest one can do it for 3 years, 3 courses, 3 levels. So that's what I did. And that the process of learning, again, it was more about learning. It's not really to show off. Designation or degree doesn't really meant then or later, it doesn't really matter now, even more so. So it was, I guess, that really helped me with the education side of things, and think of the portfolio management, the risk awareness, the ethics, which is a common subject throughout the 3 levels of the program. And that really made me think that, this is how the whole superannuation industry, or the whole fund management industry, is based on ethics and the portfolio management as a curriculum. And I'm learning from the best and reading those thick books and cheat sheets and whatnot. And that let's not forget that I didn't really had any formal training in finance.
So also the MBA, but yeah,
MBA is like very generic. It's more about how to manage the finance manager, not really about doing the accounting or stuff like that. I was like, wow. When I look back, I was like, geez, like, how did I do that? No, it's not about me. So that really got me a job in Westpac. That's how I started. So 2011, the decision that I made in 2007 to go all the way into finance really came into existence in 2011, March.
So Rasti Finance life.
Yeah, so it's just really like, this is really what I got. This is awesome. But funny enough, 6 months into the job, I was like, yeah, this is great. This is my dream role. It's my new start of the career. So starting again at a very low level. I mean, it's not really go as a fund manager right straight away. That really stuck to me, that the paycheck, the salary that I was getting and the expenses that I had to bear and the balance I was seeing at the end of the month was not really impressive.
Like most, right? You're like, okay, well, I need to do something, but you can't do much because you haven't got anything, you're saving all the way. It's going to take you 20 years to do the first thing, let's say.
Exactly. So I was stuck there. And again, someone who like to visualize and draw things on paper where it's going, the graph was not steep enough for me to see myself somewhere. other than my satisfaction of doing what I really want to do professionally. And then the pressure was, should I want to buy my own home? Okay.
Classic question. Was it? I mean, buy your own occupier, do an investment, it's
totally.
So
it was like a trend that the rent that we are paying is dead money. It's not going anywhere. I'm helping some landlord to pay their mortgage while basically I'm left with nothing. And then to me, it was like, okay, how do I, what are successful investors are doing in this country? With again, the mindset of learning first, analyzing first, finding those mentors first. That really got me in the search of finding how people make it. Yes, property investing is huge in this country, huge. Yet it's a very small percentage who makes it successful. Just by the way of sharing statistics around it, 90% of property investors in this country have only one or two investment property. 90%, 72% have one property. 18% of property investors have two investment properties.
It's interesting. I mean, we'll get to later why that size of your portfolio matters so much. But
yeah. And then it's only less than 1% who's able to do it successfully. So for me, it was the quest to find out what that 1% is doing so differently that really make them so, a class apart. So that search really took me 14 months. And with the same rigor, the way I changed from architecture to IT to finance, I really put that rigor and the focus in that quest to find out.
So what was the answer?
The answer was definitely two words answer on that. One is the strategy. And second is due diligence. So what we have learned is, which I'm a big fan of saying this or doing this in my real life as well, is that we achieve things 3 times. One in our vision, that where do you visualize yourself? Second is that vision, if you don't do anything, it's just a dream. Then the second part is planning. You need to plan where you are today to where you want to go, right? So we visualize first, that's the first part of the vision, which is more of a mindset thing. Like once we have the mindset, do you really want to achieve this? Do you really want to put a focus on that? Then the second part is trying to work out how, which is the planning part, because we all know that you fail to plan, you're planning to fail. Right? So that's the planning part. And then the third part of it is execution. Yes, I can have a plan, but if I am still dumbstruck, not really moving, I'll still be here tomorrow. Day after, I'll still be here. So it's about execution. And in property investing, execution is more so important because, as we know, it's leverage, the huge amount of money related to your own net worth. Basically. So when their stakes are high, it's very critical to have the right due diligence. So it's something similar to, what we were talking about the other day. It's more about the holistic thing. Like, how do we think about where we are today, holistically about our, finances in this scenario, and where we would like to see it? But the thing is that, again, if you can't monitor, how can you manage? So having that visibility that what it is today and where it should be going, what's probably the trend building up, and the compounding is your friend.
You cannot improve what you cannot measure.
Exactly. It's a classic, right? And then the best part of the investing is that it's something called compounding effect. It's a snowball effect. Like what I'm doing today, small habit will not really be visible until it becomes huge, but then the growth, it goes through it.
Entirely. And you mentioned that that's the strategy part. You said the second element is due diligence, so more like the property itself, right?
Yeah, exactly. So there are 15,000 plus suburbs in this country. Lots of people say or ask me, like, what's the property market doing? Like, which market? Because it's a heterogeneous market. It's not homogeneous. As in, like, which market in the markets.
Many markets in the market.
Yeah, and it takes a while to just figure this out because I guess the media can only talk about the median price.
Yeah, it's into the details.
So it's like the average price, but the thing is that property investing should be done for the long term.
Yeah.
And we need to be looking, and median is good enough. It's probably good, but only to talk about the trends in the long term. But it doesn't really help you or help anyone for that matter what the median of a suburb or the street is. It really comes down to the type of the property or, what elements of the property we're looking at. Are we talking about a 2-bedroom unit? Are we talking about a 4-bedroom house? Because they're class apart. So if you put that one together as a median, if there are more sales happening on the small size, the median will come down. If there are more sales happening here, it will go through the roof. So We really need to understand, okay, what is happening here, what's happening here. And then we can think about different geographies, different types. And so there's a due diligence around it. So I did all of that again, just like I did learn programming on paper.
Yeah, it goes back to the story. So we're at that moment. So you have the strategy part. You said 14 months, and you need to go to the due diligence. But what's the sparking moment? Because I mean, for people who listen to us to relate, right? You're like, okay, I don't have really enough to save for deposits, and that crazy story, if I can call it like this, which is
actually,
I'm going to actually pay the deposit with debt, which is actually not actually straight your money that you take out of what is usually the highest paying interest rate possible, a credit card. And you're like, okay, my plan is I've got a line of sight on interest-free period. So actually it's going to come to me for free and I'm going to be able to roll it over to make the deposit. When do you decide it? Maybe it goes to confidence, you know what you were saying before.
Confidence is one thing. The second part is that, sometimes we say risk, in our mind, we're really talking about risk, right?
Yeah.
It was a risky thing to do then, it's a risky thing to do now. So nothing changes.
Yeah.
But the thing is that how do you define risk? Risk is of getting into something unknown. If I know if it's a dark room, I will be scared to go in because I do not know what to find. But if it's my home and this is my room, I know exactly what is placed where. I might be willing to walk with my eyes closed. So, point I'm trying to make, and the reason I shared the whole story about how I actually opposed it,
thank you.
14 months was more about learning and knowing and doing things beforehand, and not just by myself. Like I actually went to paid programs, unpaid programs, seminars, books.
Would you say they were valuable? Because I think that's a very important point. People, and I said in the beginning, how do I get started, right?
Yes. So it's all about getting the right mentor, right coach.
Mentor, that's an interesting one because you can attend, glean information, but
you have to be in the circles.
Yeah, exactly. Like what by mentor implies, because it's someone walking the path with you or helping you understand how to walk that path. Like, is that can you maybe double down on that?
Yeah, sure. So it's a Chinese proverb which says that if you need to know the path ahead, just ask someone who's coming back. We don't have to make mistakes on our own when we can learn from others.
In your case, who was your mentor?
So I actually had heaps. I had many because the thing is that in property investing, there are so many strategies. And if somebody does one, it's more of that if I do one thing, I will see only that thing. If I invest in properties, if you ask me what's in my portfolio, it's properties because I know it. Right? So it's the same thing. Even within the strategies, if somebody is into the flipping, which means you buy something old, you renovate it and sell it, that becomes their strategy. But someone who's so proficient to do it is not saying that I can only do this, but he's just built proficiency in that segment of the strategy. So if I talk about renovation, this person, I can learn a lot from this person. On the other hand, somebody said, no, I'm just into subdivision. I have the neck to find the right property, which I can go and talk to the council, have the contacts, I know which lawyer to go to, and I know what clauses to talk about, and then ask for subdivision, and then I sell two parcels rather than make profit. So that's how we learn. For me, it was more around, okay, what are the ways to go from here? And that's the brainstorming part. Like, okay, from here, what all I can do? Okay, this path is for me, this path, and then you try to bring your own personality, that what suits you the best. Now, this is where architecture comes handy, my knowledge.
True.
So again, as a concept that you design your end goal first, and then working backwards. The same thing, holistic thing, as a vision, and then working backwards. It, of course, went in literal sense of architecture because now I'm thinking of design of the property, the appeal for the property. Because what I learned from my mentors, it was more about, like lots of people say this, that, okay, what's the real value of the property? And guess what? There's nothing like that. There's no term like that, real value. It could be a construction cost, like how much it costs to build it. In terms of the price exchange, it's like whatever is the seller happy to sell it for, and the buyer is happy to buy it for. Now, all of a sudden, it becomes the circumstantial for the seller and the emotional or the appeal for the buyer. So if you go the intrinsic, I guess, the way people think as selling or the buyer and who are the people involved, the stakeholders, the selling agent, and the buyer, what the circumstances are. And that's the reason why we realize that if you take a rundown property, you fashion it up and get the stylist in and get the lights and the perfumes and the candles, and all of a sudden people are buying the possibility to live in that room, the view they would share, the bed they would put, or the dressing table. They're talking about the spaces. They're no longer talking about how big the room is now anymore. So having that understanding, the psychological part of the human mind around it. So, this is more about like how to go about valuation. So coming back to the point that how did I go about doing that 80K and the numbers around my credit card, was to me as simple as, yes, 20% are on average credit card interest rate. That's daunting. That's daunting.
The CFA knows that's not a good idea.
But in funding or corporate finance, we also learned this concept, for those who can relate to this. It's called weighted average cost of capital, which is WACC, right? In short form, WACC. So that's the concept actually applied. I thought that, okay, I can go and I need to put 10% of my money deposit, and I'm getting 90% from the bank to lend to me. At that point of time, say 4% was the interest rate. Now I'm really thinking, should I really borrow 20% on credit card for a 10% deposit? My mathematical mind showed me that I'm getting 10% for 20%, which is 2%, plus 90% of 4%, which is 3.6%. If I do my WACC...
Additionally, I think you had some interest-free period, right?
Yeah. So that's the part. So to me, I'm talking about the worst case scenario.
Okay, exactly.
So worst case scenario, even if I have to pay 20% and then 4% here, 90%, to me, the cost of capital is 5.6%, as in 3.6 plus 2.
And the other one, yeah. It's the worst case scenario, because you were even better than that. You did it first.
Right. So now, of course, now it's like, okay, how can I make it better? So of course, now 20%, there are amazing deals out there. Westpac credit card or NAV credit cards or line of credit and whatnot. But the thing is, and this is really, I'm putting it out there, is to never rely on the application, because people challenge, oh, I don't show this, disclose this and that. And that's where people get in trouble. But if you show that you have the earning capacity, this is how much you're saving, and this is not borrowing, can you do that? Because any short-term benefit can really cause trouble eventually. My credit card, because I was aware that, okay, what really matters for someone who wants to build a portfolio, something matters the most is the credit file or your credit rating. Today, it didn't really matter because I'm starting my journey fresh. There's no, mark on my file bad, but that I need to be mindful of. And I knew when to stop as well. And then again, not new, I learned that first. So that gave me confidence that, okay, I can go for 5.6. And I know if I look at the history of the returns of the property market in residential in Australia, it's about 11% total return. 6% or so of capital growth, 5% or so rental yield, 5%. So I'm looking at 11% is my return, and I'm borrowing at, say, 6%. If I borrow 6% and invest 11%, I'm actually taking benefit of 5%. And if I do this for $1 million, 5% $1 million is $50,000.
Then we get started.
and I wasn't even saving 1/10 of it annually after doing all the hard work that we were doing after all that education. So to me, it was more around figuring out how this works first, then really have the heart and the guts and know-how with the support that if something goes wrong, I was very much open-minded. If something goes wrong, I'm happy to let go of the property. By the way, I'm talking about property market in 2011 and 2012, when it was not in favor. It was only because it was coming from the GFC crash down, bunch of prices. Yeah. People were very worried. Stock market, everything was driven by that around that time. All related as a sentiment. So I'm talking about really learning that first. So many gurus out there, and for me it was more about going out there, learning from them, building that confidence, and then I was evaluating the deal, talking to so many professionals. When I really felt comfortable, that's when I went to.
I think a key part of what you're saying is it was not a casino gamble, right? It was basically something well planned, You just run it through the number. I think to have the full story, you also rolled that credit card because you had to have it for several years. Yes. So you couldn't go with one credit card basically for let's say 1 year. You had to basically go from one credit card to another. Maybe you want to come back to this, but it was well planned. And I guess you obviously, like, for people listening to us, the recommendation is not like just buying a credit card, take the risk without thinking about it, and buy a property. Like, it needs to be well under control. This is not a recommendation in general.
Totally. And look, by no means they should really give a tick of approval of this kind of strategy, because too risky. It's not for everyone. Would I do it now? Probably not, because I know what it means. But that was the only ticket for me to get out of where I was, because I was already 5 years in the country and I had savings of negative because I borrowed money for my MBA, and so. Long story short, it was more about having that strategy beforehand.
Exactly. Yeah.
Having that GPS first.
How to think about it, right? How to plan for it, the financing side, if we relate to your story, is also extremely important, right? So, like, really understanding what are your possibilities, how you can structure it maybe in a creative manner, but under control. I think it's probably the main thing, and builds that confidence.
Totally. And, as you said, that 20% was extreme, but for me, that was my base number. It was not a what if scenario. It was not really the worst case scenario. That was a scenario that I was working with.
There's a lot of
and anything. Yeah. So lots of people, what we have found is that they go with the speculation, and we tend to be very optimistic in general.
Yeah.
Whatever we do, we think that we are, just like example of people buying a home for themselves to live in.
Sure.
Data says differently, right? So we have that optimism. For me, yes, I'm optimistic. Don't get me wrong. I'm very optimistic, but I'm also the one who would prepare for the worst first. That will set me up that, okay, anything better than that is actually a bonus. So yes, 5.6% that I was talking about, I was able to not only cut down my credit card debt very quickly, because I started realizing that one property is done. I mean, in 2 years' time it will be done. I'll pay off that loan, but would I want to continue for my second property? Of course not. The reason is because I want to come back for my third purchase and the fourth purchase. And I do not really want that kind of so many entries in my credit card or for my credit file that the lender might think different. You guys are broker, so you know what I'm.
Yeah, no, it does impact you. Like, if you have like multiple credit cards, like you roll over, you funds them, it does impact you. So you can't keep going like this, and whichever like missed payment or the draft will impact you again.
Exactly. So we made a commitment that we will never. I mean, by the way, I will also clarify that this was good because you are talking about good debt here.
You're actually building the credit history smartly.
Yeah, so it really helped us.
Yeah.
And a lot of people think otherwise.
Yeah.
It's because it was a good debt and we were very good in managing our funds. Believe it or not, I should run that Excel sheet, because when you have ordered so much and you look at them day in, day out, those numbers, then you really want to make sure that you do not miss out any payment, because that will come back and
everything. It's a castle of cards. If it can fall over if you don't do this.
Yeah. The funny thing, just talking about all of this, I realized that whenever, I've been very shy. I haven't really shared this much, the whole story about anything, because I really was doing all right in a job, but it was my side hustle, if you might call this. And, coming back to the point that I was able to buy one, success of that one gave me a lot more confidence. The equity that I was able to get from my first one allowed me to pay off the credit card bills. By that time, I had some savings. I went on buying the second one.
And so on.
By that time, I learned renovations and flipping. And
actually, wanted to ask you, right, because you introduced that nice, easy to get framework, like the strategy side, the diligence side, right? We talked a lot about the strategy, how you build conviction yourself. That diligence side, we didn't touch too much on it, right? Like you mentioned some possibilities like flipping or looking at the right area. I think I know, your first one, correct me if I'm wrong, was near Newcastle, and the way you went into the detail was, all right, it seems that the highway is going to open in the area, it's going to drive prices up. So you were more interested in the fundamentals and how it's what's going to drive up, interest for that area, and I assume capital gains.
Yes.
But that's only one strategy, right? So I guess that's a little bit, how would you get started? What do you think today in the current environment or for a new starter can be the best strategy? And as you grow, what are the possibilities, the different types of strategy you can employ? You mentioned renovation, for instance.
No, totally. So, great question. So, I think first of all, I would say that it's very personalized strategy. It's like what works for one might not work for other. And it also depends for the same person where they are today and where they would like to go. So this is what exactly we do. So as you know, we are running a buyer's agency now with a focus on education and strategy.
Correct. Get rep
Properties. Yeah. So it's a cheeky name or a smart name, whatever you like to call it. It's Get Rare as in RARE, which is an acronym which stands for Get Rich and Retire Early.
All right.
Because this is exactly what we have done. Like 16 years, 17 years in the country, nothing, in 5 years, and all of a sudden, in the next 6 years, we were able to build it. It's because I had that kind of insights of the learning or, I guess, the dedication to learn that first. It was all good. And so coming back to your question, first, I'll probably answer that.
Yeah, sure.
So for anyone to start, it's about journey of education first. Then it comes down to strategy. And then the strategy is more, not so much so about one property, because if you're thinking about building wealth, only two things matter. One is rate of return, which everyone probably know. And the challenge is that lots of people really go into the argument of negative cash flow versus positive cash flow property as like, how do we go about splitting cash flow and capital growth? That's only one aspect of it, which is returns. Second aspect is something that we all need to know, or for an average investor, and that's analysis or understanding or friendliness with the risk. It's about that element that makes or breaks any investor. In the sense that if you do not know for any strategy that we are deploying or working on, and if you do not know what can go wrong, and we're not really prepared for that what if scenario, and that unknown really stops us to do something more. So if I know I can do this consistently and I'm aware, believe it or not, diversification really brings down the risk at a big level. So somebody might say that, I got a risk because I got two properties. What if my tenant leaves the property? Of course, they can potentially leave. There's a vacancy less for sure. But imagine if you have 6 properties and then 1 or 2 people leave, then it's still not the same as one living in your 2 properties, as a percentage. So what I'm referring here is that if one tenant leaves in my 2 properties, it's a 50% vacancy.
Yeah.
The chances of that happening is actually 2% per property. And that's average vacancy rate. Like out of 2 years, 2 weeks your property will be vacant. So we need to be mindful of the cash flow impact that would it make.
Yeah.
Right. Now, if I have 6 properties, 2 tenants living at the same time, the probability is actually a lot shorter, a lot smaller. Because it's 2% for each. So it's,
Yeah.
So even if that happens, I've still got 4 tenants paying the rent. So in that scenario, it's only 33% vacancy. So diversification is one part. And we really need to think more holistically. It's not about buying our property and where to buy a property. For that really comes into play. But it's more about defining the ideal property first. Defining the ideal journey, defining the ideal property, and then comes, what we are deploying. What's the risk profile? There's easy money in people's mind when people think about renovation, buy for this much, do this and sell it. Thanks to TV programs like
exactly. It's like
I wish it was like that, but it's all, believe it or not, very fancy what we see on the media or TV. In reality, it's a lot of hard work. There are people who have built proficiency in the team. Just in the flipping, for example, the biggest skill is managing the tradespeople. Not just hiring them, it's managing them.
Yes,
coming out to that level, and it's not easy. Especially this market.
Yeah. Ways.
Yeah, they have their own world. You have to be part of that world. To be working with them as friends more than anything.
Yeah.
And for that reason, for me to go to that path, actually rolled up my sleeve to do renovation myself first before I managed 3 renovations on my own, that too remotely. So the essence, what I'm really referring here is that there's no one strategy that fits all. It's very personal based on where they are to where they want to go. Personal based on their risk appetite, not just their willingness to take risk, but also the tolerance of risk that they can take. And there's a difference between willingness and tolerance. So you know it well, right? So that's where it gets started. But then really need a team behind us, team of mortgage brokers. Say, I want to build a portfolio 4 million, 5 million, but I can't borrow more than $600,000. What can I do? So the person behind it, someone who's managing your property. So all those things really comes down to really building a team first. So if somebody comes to us and say, okay, I want to do something, for us, it comes down to visualization, the belief that you really want to do it, and then working it out and building their A team.
Well, I think it's interesting. I was saying, like, look, it's it's the visions, everything. There's a team around you. Look, you can work with, a property strategist like yourself, with a lot of experience. You mentioned also the mortgage broker, right? And well, this is what we do at Upworth. Exactly. And it is true that what we see is people just think in a very constrained manner. They don't think about like a multi-move game. They're like, I only get to that amount unless they are working with a property strategist, right? And basically, a property strategist is going to create that wall of possibilities. And on our side, where I'll tell you, okay, cool. Something that some people ignore is you can actually borrow against the equity you have created in the previous house, right? Which is ultimately what you did. Yeah. So all of a sudden you become less constrained. Like actually you can bring that money you created and you don't have to borrow as much as you thought you could before. So there are ways to do it, right? There are ways to make it happen.
Let's focus on that. And to me, that's the starting point. Okay, how much wealth we are talking about, how much security we are talking about, how much risk we can take to get there. So when we understand that part first, then it's a matter of, okay, now you're mapping. Like the question is like, I got a car in my garage, I got fuel in my car. Just like people say, oh, I got some money in my pocket, I want to invest somewhere. Tell me where to go, what to do. The question is, equivalent question is, I got a car in garage, I want to go. Tell me where should I go to left or should I go to right? And to me, the answer lies in where do you want to end up? And then working backwards. So to me, when it comes to the wealth side of things, it's more, okay, how much passive income you want? How much safety net you want?
I think one thing which is super important as well is how you track all of it. And you mentioned an interesting one, we're saying it's all about the return. And I think that one, what we see, and also the reason why we created Upworth is people look at return in a very funny manner. They're like, I've made that much capital gain. You're like, that's great, but like, how much have you paid in settling the property? How much are you paying for your mortgage? How much, are you getting, every month out of that property? Oh yeah, the yield, that's the thing. Yeah, again, but like, and you said there are components of one thing, which is ultimately what is your net return or the expectancy of net return you have for that one. And we are big on this at Upworth. We actually allow you to track this straight in or out.
No, I wish I had that because I was doing all of that in my own Excel with all sorts of macros and the charts coming through. But I think there's one more aspect which I really like about Upwork. It's not so much so. I mean, don't get me wrong. This is great what you just talked about.
Oh, yeah,
but there's also another part is that how much equity you have in the property, how much borrowing power that you can go and do it again. Not just tracking where you are today, but there's this what is potentially your money which sits in the form of equity.
Yeah. For users, that is something we track automatically as
exactly.
Saying. Yeah, that's correct.
Yeah. No, to me that's very powerful because when we are working with families that we work with, and now when they understood the concept of the visualization and they really want that, the will is there, the keenness is there, the team is there. Now we have to wait for the time to its magic, the compounding of the growth, and then tracking that equity.
Yeah.
And then knowing where to go again, because tracking equity means that we are going low on our cash buffer, high on our LVR as loan to value ratio. But then this, to me, I always say there's a cost, like we need to be mindful. There's a risk of investing. There's a risk,
No free lunch. That is true.
The safest money is on the mattress.
Well, not necessarily for that reason, but anyway.
So now there's a risk of investing. And people are worried about the risk because that's so much out there. They have heard the scary stories. They have seen in the media what can go wrong. Yes, the scars of GFC is still fresh in people's mind.
But what you think is fascinating. I agree with you because it feels like a pendulum between greed and fear.
Yes,
it's totally. Like, I want to make money. Look at these guys; they did well. Like, look at Rasti at 7 million. I want the same,
Yeah.
And then the other side of the pendulum is like, oh my god, like no, I could lose big. And people are like just moving between these two parts, and that usually leads to inaction.
Yes,
and that's where someone like you can actually help them, right?
Totally. And this is what I say. Like, if somebody wants to have, like, this is how I started. And probably I'll be saying, just go to a trusted partner that you can cross for kids who have achieved results for themselves and have been doing the same thing as in helping people achieve their successes as well. So go and consult with them and talk and understand.
Entirely.
But coming to the point that lots of people say, why invest? Why take even that stress around it? I always go back to the point that what really made us think about investing. And that's a desire to be on the other side. It's not really the greed. I'm not really talking about that. What I'm talking about the safety net, because we go to work, we get paid, an average Australian. What if something happens on a day that we can't go to work anymore? Whether it's a health issue or whether it is a life issue or the work issue.
You depend on your labor, your time.
Yeah, so we are trading time. Exactly, we are trading time for money. So the time we work, we get paid. And if we are dependent on that for next 15, 20, 30 years, that is the amount of risk we are taking, because we all want to retire safely with our decent means. But the reality is, again, statistics from ABS, as an Australian Bureau of Statistics, 56% of Australians do not have enough money, even at the age of 65, to retire. Even at the age of 65. So we are really talking about early retirement, and I'm saying that even half of the Australians, as per the statistics, aren't even ready to, they're not prepared to retire. And that's why we see lots of people still out there beyond their age working very hard.
And it's too late in a way, because you said it's all about the time, the compounding, the markets, trading wealth.
So now my question to the audience is that, yes, there's risk of investing. What about the risk of not investing?
The one you implicitly admit.
Yeah. And then the funny thing is, nobody's to be blamed, by the way, on this scenario. It's just the challenge of not having that enough financial literacy around it. This is very hush-hush thing, talking about numbers. And I was hush-hush, don't get me wrong. When I was doing all of this, I was very hush. It was a motivation for me to inspire. That's why I came up and started sharing my story, that I can openly share it. And I'm proud of what I did. But again, the whole idea is not about me. It's more about the story behind it. And if I can do it, anyone can do it.
Entirely. And you said it, the literacy. And I think it's a very good segue, because, on top of being a successful investor, an advisor, you're also an author. I think the financial literacy part is big, right? Whoever wants basically to, start learning about property investing, you will authored the book, The Property Wealth Blueprint. In fact, whoever, is interested in this book, watching this podcast, can reach out to us. And Rasti is actually we're offering a few free copies for the people, who reach out to us first.
And exactly. So a bit about book. It's actually a blueprint of how to build wealth through properties.
And you're actually an Amazon bestseller author. Yes, I forgot to mention, because this is quite a thing.
Yeah. No, you're all right. No, again, so the story behind it is, I was really having a good time in my corporate world, managing big amount of money as a CFA and MBA, and it was my urge. I actually went to this Tony Robbins event in 2019. That's how it started, actually. September that I went to, and we literally walked in the fire on the pole, got blisters. Part of the program called Unleash Your Power Within.
Okay.
Big guy, Tony Robbins.
Anthony Robbins.
So day one was good, all good, all high-fiving and shouting and, clapping and whatnot. And it became more of a spiritual journey, and then more of a inward looking and retrospection and reflection and what you have done and what you got achieved, or what you have achieved so far. I went just for the sake of experience, because I've learned so much from so many people. And if somebody's offering that program and written multiple books, I thought, better go and check this out.
Good curiosity.
Yeah, exactly. It's costing me a bit of money and some time. I should go and check it out. And for me, it's about meeting more people out there. That's how I started. But day 3, dim lights, and I'm talking about 20,000 people in an arena in one go, dim lights, and I felt that he was talking to me personally, one-on-one.
Impressive.
That's all. And he's talking about this thing, everyone does for themselves. They do it for themselves, they do it for their family, for their loved ones. But what are you doing for others? How would you like to be remembered when you're gone? what will people say on your obituary? And what do you want them to say? And that's where people really started. I mean, I could feel that because those eyes was closed, but people were shouting, yes, it's me, and the energy level. And really got me thinking that, yes, everyone does that. Like, what do I want to do? And that is the time I realized that this is the combination that I have as an architect, as an IT data scientist, as a fund manager, knowing about the risk, knowing about the vision, and working on that backwards is probably something I would like to be remembered for. This is what I really want to pack it up as a package, as a book, that I want to pass it on to people. That really got me to write this book.
Wow. No, lovely story.
And I came back as a resignation in my hand that, okay, I want to do this.
Wow, okay, so that was the spark, actually. All right. Well, thanks for sharing. And the book, correct me if I'm wrong, is more like about teaching you, learning, like how to think about properties. A question I raised in the beginning, and I think, something which is on everyone's mind is, where should I look at, right? So what would you say to people, today, like if you want to invest in Australia without revealing all the secrets, obviously, that, you share with people when you work with them, but like helping them understand how maybe to look at the right areas, what are you looking for? If you were Rasti back again in 2011, starting your portfolio, as we know you did, where would you look,
Look, it's a very interesting question. I get this question all the time. And
Sorry, I'm not-
no, it's all good. And I always answer this way, and I'm more than happy to be sharing this again. It's not about property.
It's not about the area, right?
It's not even, and that's what I'm saying.
Not about the area.
It's not about the area either. It's why people are buying property. It's probably because they want wealth, because they want financial security, because they want safety net. And then, depending on quite a few factors, just like in GPS, you put the destination, the end goal. It is smart enough to know where you are. But then also ask one more thing, a few things around it. It's your preferences. Do you want to take a toll road? Do you have enough time? Do you want to go and meet somewhere on the way? Do you want to take a scenic route? So those are the preferences. Those are the same GPS, same starting point, same end point, but now it's more personalized for that person.
So doesn't walk backwards and be like,
yeah,
given the set of preferences and goals, let's look at this route.
Yeah. So now it's more about, okay, when do you want to retire? So I was talking to someone yesterday saying that, okay, I'm 33 years old and I need to have this much passive income by the time I'm 50. So to me, now it becomes a journey of 17 years. This is what he wants. But now there's a misalignment. He's like, no, I'm not really too comfortable with debt. So now it's more of working out the alignment of that. Like, either we need to, again, the risk is investing versus the risk of not investing. So coming back to the question, where should I go, is dependent on where you want to end up. What is your risk appetite? How much is your savings plan? How much is your borrowing power? Right? And how it changes over the period of time. So it's need to be tracked. Again, something where the wonderful tool equipment can come into play. So to me, it's not so much about which area, because that keeps changing. When we are buying for the long term, this is really the myth. Like, lots of people think that I'm buying today, I need to buy the best property for today.
There is a sentiment, right? It's like, what's the next hot area? Where do I need to be?
But the problem is, we are not selling it after a year, after 2 years, after 5 years, right? We are buying with the mindset of holding it forever. So we need to buy the property which suits the long term first. Then comes the short term and the mid term. So let's not forget that we are buying for the long term. And then picking up market, or picking up that property market, which is not only good for the long term, but can also give you the kicker for the short term. Now, where that area lies in is a question of what's the exact brief we are looking at. Like, what type of maintenance issues, what type of cash flow we are expecting, what type of risk we are taking. As an example, like when we started in 2010, 2011, like studying all of this, there's a huge, build up or the sentiment for the mining towns in Australia, because
yeah, correct. Yeah.
Lots of people saying 10 11% yield and that kind of growth that we are seeing. And the only thing that was very spiked up, even on the papers, was the risk, because it's only dependent on one industry, mining industry. So if that mining industry, something goes wrong, the whole market of that area will come crashing down.
Yep.
So buying something which is appealing to the home buyers, as in the owner occupiers. If I have to really give that criteria, it will be more around A, go work with your budget, buy something which is for the long term, go and look for something which is appealing to the most, as in it should be a diverse industry area. Like if one industry goes down, there are still many other industries. Within your budget should suit you as an individual who's buying it and suit your portfolio. Again, just on this very quickly, people think about one property in isolation. It's really actually what role that property plays as one asset compared to your overall portfolio is the key. It's a team play. I mean, of your properties or for your assets.
Yeah, and
how they work together.
To put it in practical terms, saying like, is that property the one generating a lot of cash, good yield? Is that one generating, like a lot of latent equity potential with a renovation? Is that one, the one that's going to have big capital gains? Like, that's what you mean, right? When you say
exactly right, exactly right. So I can't just say, oh, this property is costing me too much.
Yeah.
But it's like more of a defender property compared to this property because this is giving me,
Yeah, which is a good analogy with stocks. It's the same thing, right? It's like a property at the end of the day, like it's one stock, of value, and it behaves in a certain manner.
Exactly right. So it's more about the interplay of your properties and not just the properties alone. Then it really comes down to if somebody has so much of growth assets like the stock market, right?
Yeah.
Again, it's a defensive play at the whole holistic approach. So what we really focus on is about the holistic approach of building a portfolio.
But on that one, I think some people may feel like, and obviously you did it, so it's a good illustration and example of like it's possible. But like people might feel like, look, is selling me that vision of like a multi, property portfolio, but I can barely, buy one. How do I make it happen so that I have 4 or 5, whatever the right number is for you? And what's your answer to this? We touched a bit on this during the conversation, but you're saying no, it's possible, even if you're not like earning, 500K a year.
Yeah, look, first of all, let's break down like why a portfolio is better than 1 or 2 properties. So for someone who has a capacity to buy $1 million today, it doesn't mean that's the total capacity forever, right? So it just means that, okay, $1 million today, if you hold it well and it does well, first of all, the key thing is about basically 3 things. It comes down to really 3 things. One is your deposit, like how much deposit you can accumulate over a period of time, which can come in form of your savings as well as it can come in form of the equity on your portfolio.
Yeah.
Second part of that is your borrowing power, which basically is dependent on many things, not just your income levels. Because as probably you know better, maybe I would like to ask you as an example.
Fantastic. Fantastic, Rasti. Thanks for that last point. Maybe, before we wrap up, the question we like to ask is how your own portfolio looks like. Many times, it looks a lot like the asset class someone is deep in, property, stock, in your case, and you don't have to share any numbers, like what's the split, the breakdown between different asset classes that you have?
Yeah, so like I'm being a CFA, I've always believed that it's all about the balance in the portfolio. That really is critical. And we all know that we should not put all the eggs in one basket. However,
you're also a property strategist.
however, when you know how to look after the basket of your eggs, then it's probably safer to put more eggs in the same basket because now you're watching it. That's my philosophy. Because now I know what I'm doing, and especially when it comes to property. So I thought I was giving a bit of context around it. So my portfolio as of now is 5% stocks, 55 in property, 40% cash.
40% cash.
Which is
walk us through that.
Which is ready to go in again further to build it up back in the property.
All right, so it's a deliberate decision, but it's an interesting one. So this cash, obviously, I mean, look, I assume maybe you have a little savings account and, it's actually returning something, but does it mean that you haven't found the right property and so you're basically holding and you're like, I haven't yet quite deployed because I'm like, I haven't quite found it? Or is it just because you haven't had time? Like, what's
No. So the thing is that it was more about a strategic decision. When should I go and tap the equity in my portfolio?
Okay.
So that I can, until now, I was going with my own, the strategy that I was talking about that I probably visualized in 2011 before I started executing. I had a plan to build a portfolio of 5 million.
Yeah.
That's what I did. until 2017.
Yeah.
Then over the period of time,
6 years. Yeah.
yeah, so it really built up. The equity kept on going up.
Yeah.
That's how the equity built up, and as in the value of the portfolio. But now it's really taking up the notch up by revising my goals for the next 5 years and what should I be doing.
Yeah.
And this is more about an opportunity for me to go to the bank, rejig the numbers, and how much equity I can take safely. What can I do? And that's where the money is coming in. And I'm looking for the right opportunities because to me, this is one of the best time. Like contrary to what people might think, some of us, this is the best time when it comes to the property market, especially when we see the fundamentals of long-term supply and long-term demand. This country, we all know, is very much dependent on immigration. Like you and I, as an example, we came here. And the only way, and it's an aging population, the demography is aging here. So what it means for the government, it doesn't really leave too much choices, but to welcome someone like us, working class students who end up staying here.
And to put things in perspective, I think we're talking a bit more than 40 million Australians in 2060, if I'm not wrong.
There you go.
That's the ballpark.
So from where we are, 26.5 to 40, like it's a huge number.
Which is a higher growth rate than actually any other developed market, like, according to UBS, if I'm not wrong.
No, exactly right. So now the thing is that what's really going on? Like people need to come, and people when they come, and that's where the strategic thinking comes into play. They're not really buying multi-million dollar properties. They are probably people who are coming in. They are either renting, helping the landlord, or they're trying to buy their own property to start at the lower rung in terms of the value of the property.
Yeah.
So that's where the diversification helps us as well with the same methodology or thinking. Because when we buy a $500,000 property, even when it doubles after say 5, 7, 8 years, we might still be able to find $1 million buyer of that property. So this is really what's happening, and the suppliers actually have gone out away. Like it's very hard to find right builders, and the government is doing a great job for whatever they are able to do.
Yeah,
I mean they have limited hand to play, right? So the whole thing about build to rent or the equity injection by the government, they are very good measures, but they are still not doing enough. Like the demand that we are seeing, the affordability issues that we are seeing. So government has no choice but to keep immigrating people so that they can tax them. And what it means, the fundamentals that they will be long-term demand for the people to come in and buy properties, and the supply is limited because the construction companies are under pressure, or the cost is very high. So looking at the fundamentals and looking at my risk appetite, looking at where my cash is, how much buffer I can leave, I'm really going back again to build further up my portfolio from here.
Fantastic. So we meet in 5 years again, and the portfolio will be at 15 million. Like we have another podcast. Take the challenge.
Hopefully much sooner. And this is what we have been told and we have learned. Making the first $1 million is the hardest. Going to second or third or the fourth is probably not that hard as what we see the first $1 million. So I would hope to achieve that much sooner. So it's
challenge taken. I'll call you in 2 years. I think Rasti, thanks a lot. I think it's actually like a good way to probably close that conversation. I think hopefully you also found it quite exciting, quite inspiring. Rasti is an incredible character. Thanks for sharing some very personal parts as well. I think it was quite deep, and it just puts everything in perspective. Where you come from. Hopefully people can relate, and where you can go. So thanks a lot for your time. Don't forget, it's a very valuable reading, and Rasti is very nice and happy to basically offer some copies for whoever's interested. Just reach out. Thank you so much.
Thank you so much. And for anyone who would like to have a catch up, coffee, Zoom, more than happy to do so.
Thank you so much. Thanks a lot. Bye bye.